You've spent hours running the numbers, pulling the credit, and building the perfect pre-approval file. Then, radio silence. You find out later that the client walked away because a competitor offered an interest rate that was just a fraction of a percent lower. To prevent this, you need a 5-step consultation framework designed to secure a client's commitment before you ever begin the heavy analytical lifting. Implementing this system shifts your role from an unpaid data entry clerk to a retained consultant whose time is a protected asset. Step 1 begins by asking the client a disarming question. Has anyone explained to you how mortgage companies actually make money? Usually, they have no idea. This is a loan-level pricing grid. It shows that as the interest rate descends, the upfront fees required to secure that rate climb significantly. Those ultra-low rates seen in consumer advertisements aren't standard offers. They mathematically require high fees and discount points to exist. Physically showing this matrix helps the client realize that the teaser rates they see online often come with hidden costs they aren't prepared to pay. Leading with radical industry transparency provides a foundation for the relationship that traditional sales pressure cannot replicate. In Step 2, you must prove your professional competence. Never assume the client has already chosen you. They are still in the evaluation phase. Deploy overwhelming social proof by screen sharing a consolidated page of your 5-star reviews. Let them see that your reputation is backed by a track record of reliability. Transition to Step 3 by using story selling to communicate your competitive advantage. Share a story about a rate renegotiation policy. Explain how you helped a past client lock in a ceiling to protect them from market spikes, while still lowering their rate right before closing when the market improved. Establishing this combination of public approval and structural safety addresses the core anxieties that drive clients to keep shopping elsewhere. Step 4 is the critical juncture. You must look the client in the eye and explicitly ask if there is anything that would keep them from working with your team on this loan. Be direct about how you are compensated. Remind them that you work for free and don't get paid a dime until a loan successfully closes. This isn't an apology. It is a necessary boundary to ensure your team's limited operational hours are spent on committed clients. If the client admits they are still shopping around or have a meeting with a competitor, maintain your composure. Agree with their hesitation and schedule a follow-up meeting specifically for the day after their appointment with the other lender. Arm the client with 3 technical questions to ask that competitor. This shift moves you from being a rival to being their most trusted advisor. Forcing this moment of friction ensures that your energy is spent on committed files, while identifying the shoppers who were never going to move forward. Step 5 is the final seal, the human follow-up. After your meeting, send a video recap to solidify the bond. Record a casual video message on your phone. Do it after hours, in a garage or a kitchen, somewhere that is distinctly personal. When you reveal these small details of your personal life, you move beyond being a voice on a phone. You become a person with a family and a schedule. Vulnerability and human connection provide a level of social accountability that makes it much harder for a client to ghost you later in the process. This framework works because it moves from education and proof to a direct ask and a personal connection. Your immediate action items are to bookmark your pricing grid and prepare a screen share layout of your top reviews. Practice the commitment script out loud until you can deliver the compensation explanation without a hint of hesitation. Mastering this workflow ensures that the power dynamic of the loan process stays exactly where it belongs, with the professional.